Digital assets have moved from the fringe to the balance sheets of major institutions. And as investors know, they are volatile. Advisors can ignore the noise, but they cannot ignore the client demand. And today, we're going to explore why Bitcoin has value, its potential role in a 60-40 portfolio, plus the use case for single asset ETFs.
You're listening to the Resilient Advisor podcast. This episode of the Resilient Advisor is brought to you by the Titleist Advisor Network, where independent financial advisors become resilient, high-growth business owners. Since 2003, we've been private equity-free, helping advisors build real equity in their firms. Learn more at jointitleist.com.
Welcome to the Resilient Advisor podcast, where we bring industry experts to help you build your business your way. My name is Jay Coulter, and my guest today is Matt Hougan, the Chief Investment Officer at Bitwise. This is his fourth appearance on the Resilient Advisor podcast. Matt, thank you so much for coming back on.
Jay, I'm so honored to be here and excited to be notching that fourth appearance. That's pretty fun.
Well, let's go back in time. So I went to go look at some of our old videos and look at this screenshot from our first video. My goodness, you have aged incredibly, and I'm aging like milk in a sauna.
Come on, you look great. We both look great, even today. That's funny.
The crazy thing is I went and got a date for that, and that was October 13th of 2020. And actually, I started a series on Bitcoin and digital assets because I didn't understand them. And you agreed to come on. Tyrone Ross came on, Adam Blumberg, the team from Tidal came on to talk about the block ETF, and it was really an interesting learning experience. What's even more interesting is if you had started allocating to Bitcoin then, at the close on the day we did our first broadcast, Bitcoin was at 11,400. And I specifically remembering, because you were the last interview in that series, I thought, oh man, I think I've called the top here because it's up to 11,000. And over the past 5 years, it's continued to deliver upside with a whole lot of volatility. And unpacking that, I think, would be very helpful for advisors and anybody who's watching. If you're watching live and you would like to ask questions, simply type it in the comment section. You can do it on LinkedIn, on X, on YouTube. And if it's an appropriate question, I will pose it to Matt. So let's get started with the most recent article that you published on why Bitcoin has value. And I felt it really kind of cut through the noise in a way that advisors could actually use with their clients. What drove you to write that article?
Yeah, it was actually a question by an advisor. It's funny that you asked that. We did a meeting with an advisor where they had one pro-crypto person and then an investment committee that had varying levels of skepticism around the asset. And they asked me to explain why this asset, Bitcoin, which is worth $2+ trillion but has no cash flow, why it's worth anything at all. And the answer I gave is the answer that I gave in that piece. And after the discussion, they decided to allocate, and they asked me to write down on paper something that they could share with clients if they felt appropriate to help their clients understand why this asset had value. One thing that's very true in crypto is there's a lot of media coverage. There's a lot of writing. There's a lot of crypto Twitter. Not all of it is very clear or easy to understand. There's so many buzzwords. There's so much sort of fuzzy math that I really just tried to boil it down and say why I think this asset has significant value today and why I think it will have even more value in the future.
Matt, it reminds me of a meme that I first saw when I first started trying to understand the digital asset space. And it's a roller coaster ride of somebody saying, oh, I understand crypto. I don't understand it. I understand it. I don't. It's a journey that investors and advisors go on. So, I don't want to lead you on this. Walk us through exactly how you could go as a financial advisor and understand how it has value and explain it to your clients.
Yeah, the way I describe Bitcoin, well, maybe I should start with the challenge. The challenge is it's this intangible asset which you can't touch and has no cash flow. And it's really hard to wrap your mind around something that you can't touch being worth a couple $1 trillion. The way I think of Bitcoin is I think of it as a service. The service Bitcoin provides is the ability to store wealth in a digital format without a government or a bank. Now, we're all used to services having value, right? Microsoft provides a service, the ability to edit Word documents and do Excel and do Teams meetings. The reason Microsoft, the company, has value is that the more people who want that service, the value goes up. Fewer people want it, the value goes down. No one wants it, the value goes to zero. The way that value accrues is if you want Microsoft service, you can write a check to Microsoft and someone in Redmond, Washington will deposit that in a bank. And that's how they generate earnings. The difference with Bitcoin is that there is no one to write a check to. If you want the service Bitcoin provides, the ability to store wealth in a digital format without a government or a bank, you can't subscribe to it. The only way you can get the service is by buying the asset. If you buy the asset, you get the service. But other than that, they're exactly the same. If more people want it, the value goes up. If fewer people want it, the value goes down. If no one wants it, the value goes to zero. The reason Bitcoin's gone from $11,000 when we talked to close to $90,000 today over the last 5-ish years is more and more people want that service. We had the great inflation post-COVID that made people want hedges against the debasement trade. We had the launch of ETFs, which made it easier to access Bitcoin. Today, the Harvard Endowment wants the service, and Sand Druckenmiller wants the service, and the Abu Dhabi Sovereign Wealth Fund wants the service, and I want the service. If you don't think of it as an asset and instead think of it as a service, it starts to make sense why it has value. There's just the way you access that service is different. Instead of writing a subscription check, you buy the asset, but otherwise it's exactly the same. And I think that helps some people explain it to their clients.
Yeah, I really like that framework. In this article, you also talk about the fact that the value is rooted in scarcity, utility, and network strength. Could you walk us through at the 101 level why that is?
Yeah, absolutely. To start with scarcity, Bitcoin is the first scarce digital asset ever to exist. And that's actually an important thing for people to understand. It's not because someone sat down and created an Excel spreadsheet and said, this is Bitcoin and you can buy it. That wouldn't actually be scarce. People tried to do Bitcoin-like things for decades before Bitcoin. The problem is if you, Jay, create Jcoin, and all Jcoin is an Excel spreadsheet on your computer, and it gets to be worth a lot, you could change the number of those coins that exist. People have to trust you. The example I give that makes people sort of hit this home is imagine if Mark Zuckerberg created Bitcoin, but he controlled how many Bitcoin there were. Would you really trust him to stick at 21 million? Would you really trust him to honor that you owned this one and no one else could take it for you? The beauty, the sort of genius of Bitcoin from a computer science perspective is they made it so you could have a scarce asset and you didn't have to trust anyone to know that that scarcity won't change. You don't have to trust a government. You don't have to trust Mark Zuckerberg. You don't have to trust Matt Hougan or Jay Coulter. You just know there's only 21 million Bitcoin. That's all there will ever be. And the world has decided that this is a high quality store of value asset. And so the more people who want that, the price has to go up, right? I mean, that's the core thesis behind Bitcoin's price going up. If you look at how much money is stored in gold, it's about $27-ish trillion globally. If you think the same amount of money will eventually be stored in Bitcoin, every Bitcoin mathematically has to be worth more than $1 million. That's just the way it works. And of course, the other things you mentioned, like the network, is important. The more people who exist in the Bitcoin ecosystem, the more liquidity there is, the more volatility is dampened down. A lot of people use Metcalfe's law, which is a way of valuing networks, which says the value is the square of the number of people who participate in it. A social network with one person has no value. A social network with 1 billion people is meta and it's worth, $1 trillion. And the same is true with Bitcoin. When Bitcoin was just a few people, it wasn't valuable. One of the reasons it's so valuable today is it's, 100 million, couple 100 million people globally that participate in this network. And as that expands to 1 billion, the value of it goes up as well.
How about the utility component? What is the utility of Bitcoin?
Yeah, I think it has current utility and future utility. So the current utility is what I mentioned earlier. It's that service. It's the ability to store wealth in a digital format without a government or a bank. That is just a service that people want. And some people listening may not want that, but I want that. I want to be able to store wealth in a digital format without a government or a bank. Historically, we've done that in gold, which is a physical format, but the world is increasingly digital, and it's nice to be able to move your money at the speed of light. It's nice to be able to store it personally instead of relying on a bank. And Bitcoin provides that service. So that's its current utility. I think it does have future utility in a more payments-oriented role. Where I think that utility comes is, look, we're moving to a multipolar world. We used to be in a dollar-based world. We're now in a dollar, yuan, ruble, yen. There are more currencies that are relevant. You're seeing countries politicize those currencies. I think it's very possible at some point in the future, countries and entities will want to interact with a non-political currency. They just won't want a currency that a government might devalue for domestic reasons, or increase the value of for domestic reasons, or seize or monetize. They may want a neutral asset. And Bitcoin's actually the only asset that can fulfill that. So as its volatility comes down, which it's been coming down, I think you'll start to see it pick up the second utility, which is facilitating international trade when people want a non-political option. And I think that's a big market too, and it's not priced into the price at all.
So when I think about it as being a monetary asset, here's where I really struggle. I think, was it Steak and Shake says they'll take Bitcoin for burgers. So you're going to pay capital gains to buy a hamburger. Like, how is that even going to work from an execution standpoint?
Yeah, so that's not going to work, is the short answer for that. The thing about disruptive technologies that you have to remember is they have to be, 10x better than something else in order to change that use, or they have to serve a new use case that's not served by the existing format. For you and I operating on a daily basis in the US, buying our Steak and Shake, dollars are great, right? Like, dollars are easy to use. There's no tax. You don't have to file a report with the IRS at the end of the year that said you bought a burger. Like, that's a crazy idea. So that's not where the use case will evolve. But imagine you're two countries that dislike each other. Imagine you're the US, and you pick your country that you need to do business with. And you can't agree on which currency to use. There currently isn't really a solution. You've seen people sort of experiment with using gold for those use cases, but gold is hard to move. You need to fly it in airplanes or ship it on boats. Bitcoin is just a better solution in that world. Now, there's no guarantee that that market is enormous. I'm not saying it's enormous, but that's where you're going to start to see real world utility built in. You and I come from sort of an ETF background. And in the early days of ETFs, their first uses weren't by investors. Long-term investors looked at ETFs and were like, you have to trade them and hold them differently. They may have spreads. Why don't I just use mutual funds? But mutual funds didn't serve one use case, which was institutional traders who needed intraday liquidity for owning the S&P 500. Previously, they had to buy 500 stocks. Now they could buy SPY. And it was just a new thing that mutual funds couldn't do. So if we zoomed back to 1993, we'd be looking at ETFs at an investment perspective and saying they trade at wide spreads. Why wouldn't I just buy a Vanguard institutional class mutual fund that's cheaper? They'll never catch on. What we missed is they served this new use case. And as that use case grew, they became more and more efficient and more accepted. My long-term view of Bitcoin as a monetary asset is it will find traction in these niche areas that aren't served at all by the existing system, particularly the need for a non-political currency that can move around the world at the speed of light. And then 5-10 years later, could they be used more for domestic payments? Maybe, I don't know, but that's not core to my use case. You can get Bitcoin well north of $1 million before you ever use it at Steak and Shake. Again, gold is a $27 trillion asset. When's the last time you bought French fries with gold? I've never done it. And yet here we are.
That's right. That's right. And this probably dovetails into the answer you just gave. But in that article, you talked about how other monetary assets have historically merged in a similar pattern. And I think it's a pretty important framework. Could you just lay out how advisors could explain that to clients who are skeptical about having it in a diversified portfolio?
Yeah, there are many ways to tackle this, but if you look at the history of monetary assets, they typically emerge first as a store of value, right? Because they have to sort of establish a reason for being before they can move on to be a means of payment or a unit of account, which is typically the other major use cases for money. A way to think of it with Bitcoin in particular is like imagine using Bitcoin today to go to Steak and Shake. It's not easy, it's imperfect, but it's not impossible. Like Bitcoin apps are pretty easy to use. The market is extremely liquid. Steak and Shake can convert its Bitcoin to dollars very easily. There's a regulatory framework, et cetera. So we're like closer to that. Now go back to 15 years ago when Bitcoin was first created. You basically needed to mine your own Bitcoin. There was nowhere to buy it. You couldn't trade it for dollars in any liquid format. There was no regulation. It was impossible. Bitcoin couldn't have emerged into the world as a means of payment. Like it has to go through this process of accumulating value. It has to go through the process of volatility coming down. It has to go to the process of liquidity increasing and acceptance increasing. And it's been on that journey, right? Volatility has fallen more than 70% over the last 15 years. Liquidity is up an infinite amount. It's now a $2 trillion asset. You can start to talk about settling international trades in it. So it's on this journey from store of value down towards means of payment. And there's no way to ask it to like emerge in the world fully formed. A similar point on that, Jay, is people always say, isn't Bitcoin too volatile? Well, sure, it's more volatile than gold. But again, it's asking too much for it just to like pop on the scene and be instantly accepted everywhere and not volatile at all. It has to go on this journey where it gets more valuable, less volatile, and more liquid in order to get to the point where it has similar volatility to gold. Like that's the only reasonable way. And there's no way of looking at the last 15 years of Bitcoin and saying, so far, it's on that path. Doesn't mean it will stay on that path, but so far it's been following the only pathway possible to being a $30 trillion asset with limited volatility and eventually a means of payment. It's just, you can't imagine it goes from 0 to 100. It has to go to 1, 2, 3, 4, 5.
Makes perfect sense. I tell you, Matt, when we did our first interview 5 years ago, one of the things we talked about is a white paper that you co-authored with the CFA Institute. At the time, I sit on a lot of investment committees through my consulting business. Nobody had access to digital assets. The follow-up that we talked about in that interview was to read that white paper that you co-authored with the CFA Institute. I would say the article that we're talking about right now is an incredible resource. And an even better resource is what you folks at Bitwise have put out inside of the expert portal. I logged in there as I was preparing for this interview, and I'm blown away at the depth of research. Could you walk folks through what they would get if they signed up for the expert portal?
Yeah, absolutely. And signing up is free. There's a lot of information in there, all designed to help advisors understand crypto and have conversations with their clients. So to take a couple examples, you're seeing here the weekly CIO memo. I write it every week. It's on the most important topic in crypto. Sometimes it's very news focused if there's big news. Sometimes it's more big picture, like why Bitcoin has value. The beauty of that piece is it's always around 500 to 1,000 words because I know advisors are busy. So you can't digest 6,000 words on crypto. You need something short and clear. We create that. Other examples of things we have in there, we have libraries on the top questions in Bitcoin and Ethereum. These are designed specifically for advisors who have clients who might ask them, what about environmental impact of Bitcoin? Now you have a resource that has a 1.5-page answer to that question. What about money laundering concerns? You have a resource. How do you value Bitcoin? You have a resource. What about Ethereum? What makes it different from Bitcoin? And we're going to be rolling out more libraries on newer assets like Solana and others in the coming months. There are also white papers. The core idea is, look, crypto is a kind of strange market in that there are many retail investors who spend a lot of time reading about crypto and have very clear opinions and strong views. And sometimes they spend much more time even than your average advisor will. And we want to be the resource to help you answer those questions that clients have. I'll say one more thing for advisors, a service that's not on here, but is something that Bitwise holds dear. We have a question answering service. So as an advisor, whether you're a Bitwise client or not, you can ask us a question about crypto that you might have gotten from a client, and we'll get you an answer in 24 hours. It'll be written by a research team member at Bitwise, reviewed, and sent to you an email within 24, I should say, business hours. If you send it to us on Saturday, we're not going to get to it till Monday, but we will get to it on Monday. You can use that at any time, sales@bitwiseinvestments.com, or if you reach out to your local wholesaler, they can hook you up. And again, our goal is to be in the corner of advisors helping to understand this complicated space.
Now, one other tool that I appreciated as I was digging around is this portfolio simulator. Very robust. And again, the resources inside of here are perfect for any advisor who really wants to go deeper. As our mutual friend Tyrone Ross always says, you have to educate before you allocate, and you really get more comfortable with it. And I had mentioned that nobody was allocating to digital assets 5 years ago in my network. And today, over 75% of investment committees have allocations. And that's because of the ETFs that have come into the marketplace, making it possible for them to do that.
I love that. Yeah, that portfolio simulator is great. I even use it to model what the historical impact of different mixes of assets will be, and we'll plan to add more tools over time.
All right. So the number one question I get is, Jay, if we go and we leverage these exchange traded funds to allocate to digital assets, what's going to happen when the supercomputers can crack the codes to everything? I get annoyed by the question, and I have an answer, but Matt, you talk to thousands of advisors a week. How do you answer the quantum computing question?
Yeah, it's a good question. The first thing I do is explain why it's a concern, because I think people hear it's a concern and they don't know why it's a concern. So let's first go negative, and then we'll get to the positive, because I don't think you should be worried about it. The reason it's a concern is that the core cryptography that underlies how crypto works, the crypto in the name, cryptocurrency or crypto assets, is based on the law of large numbers. Essentially, I have a Bitcoin password. It's a very long number. If you want to crack my password, you have to guess that number. It would take a normal computer 1 billion years to do so. Therefore, it never happens. Therefore, it's extremely secure. The worry with quantum is that a steady state quantum computer could theoretically effectively guess everything at once, and therefore it cracks this style of cryptography. I'm not worried about it on an existential level, because there are solutions to this problem. Actually, the same cryptography that underlies how crypto works underlies how the internet works, how texting works, how military communications work, how point of sale transactions work. I raise all that because there's a lot at stake for having quantum resistant cryptography, and there are huge advances in quantum resistant cryptography. And I'm confident we'll get to quantum resistant cryptography before we have one of those James Bond computers guess all the numbers in the world instantly. Otherwise, you should worry about nuclear codes more than you should worry about Bitcoin. The reason I said it's not an existential threat, but it is an implementation threat, is because at some point in the future, Bitcoin and other crypto assets will have to upgrade their software to a quantum resistant form of cryptography. And many individual wallets in crypto, particularly in Bitcoin, will have to transfer assets to quantum resistant wallets. The analogy I make is something like the Y2K bug. The Y2K bug was something that we worried about, and indeed, if we had done nothing about, may have disrupted certain systems. But it wasn't an existential threat. We didn't all die on New Year's 2020 because we could solve this through traditional work in computer science. The same is true in Bitcoin. There will be a moment where we'll have to upgrade, and that will be a big deal. We'll have to make sure we do it right. And these wallets will have to move their Bitcoin. It's good that we're talking about it, but it's not the black swan that's going to destroy everything.
I like your answer better than my glib answer, which is always, you're worried about your Bitcoin, your bank's going to get hacked before your Bitcoin. The nuclear code's even worse than having your bank account hacked, right?
That is true, but it's actually a really good point. The level of cryptography used by the traditional banking system is actually much, much, much weaker than Bitcoin itself. And so they are acutely exposed to quantum. So that is a very good point. The canary in the coal mine will be JP Morgan. It won't be Satoshi and Bitcoin. That is well down the chain.
All right. Let's move on to Bitcoin's role in a 60-40 portfolio. And 3 specific questions that you address in a paper. Again, I encourage everybody to head over to the Bitwise site. The resources in there are fantastic and robust. This research paper came out, I believe, earlier this year, and it's entitled Bitcoin's Role in a 60/40 Portfolio. And there's really 3 key questions. So first, what is the minimum acceptable holding period? What is the best rebalancing frequency? And how much Bitcoin should you add to a portfolio? I get this in investment committee meetings, and I'd love to get your response one by one. So what does your research show about the minimum holding period required for Bitcoin to have positive contribution to a 60/40?
Yeah, great question. Really important. Longer is better up to a point. So what we did is we looked at all available data. What happened if you took a 60/40 portfolio and added some Bitcoin and rebalanced, going all the way back to the start of Bitcoin? I think the paper focuses on 2014 onwards, because 2013 Bitcoin went up 5,500%. It just makes the numbers look a little silly on the upside. So, but what we found is that the win rate, the percentage of time that your portfolio had a higher return and a higher risk-adjusted return versus not adding Bitcoin, was around 75% if you held for a year, got into the 90s if you held for 2 years, and it's 100% if you held for 3 years. So to me, if I'm allocating to Bitcoin, I'm looking at a 3+ year hold. There's never been 3 years in Bitcoin's history, even if you top ticked it, if you bought the absolute top, there's never been a 3-year period where it didn't boost your absolute and risk-adjusted returns. And even in 2 years, a 9+% win rate is a pretty good win rate for an asset. So it's designed for long-term allocations. I don't know where Bitcoin's going over the next few weeks, Jay. But over the next few years, I have confidence in the direction it's going.
All right. So I'm a big fan of dollar cost averaging, whether you're doing that into a S&P 500 ETF, gold, or Bitcoin. It just seems to make sense during the accumulation years. But if you are in your decumulation years, adding it to the portfolio with a long enough holding time period can really enhance your risk-adjusted returns over a 3-year period. Fair statement?
Oh, I'm sorry. I'm having trouble right now.
No. Are we back on?
I can hear you in and out. Why don't we try one more time?
So I tell you what, if the way I heard the answer to your question is, if you're in your accumulation years, you should be dollar cost averaging into a portfolio, so it shouldn't matter as long as you have that allocation. In your decumulation years, when you're pulling money out, it could provide a hedge in a diversified portfolio as long as your holding period is 3 years or longer. Is that a fair summary of that?
That's exactly right. Yep.
Okay.
Yeah.
All right. So secondly, your team evaluated the rebalancing frequency. What did the data tell you?
The most important thing about rebalancing is that you do it. We looked at a variety of different approaches. We looked at annual rebalancing, quarterly rebalancing, monthly rebalancing. We didn't publish it, but we looked at tolerance-based rebalancing, like you allocate and then you rebalance if it hits 50% outside of your target allocation. And the biggest difference was between rebalancing and not. If you didn't rebalance, Bitcoin eventually becomes the dominant force in your portfolio and the volatility spikes sky high. If you rebalance, whether it's annually, quarterly, monthly, or on a tolerance basis, it constrains the volatility such that the portfolio is actually not much more volatile than when you didn't have Bitcoin. And the reason for that, of course, is though Bitcoin is volatile, it's not historically correlated to stocks and bonds. So when you add it into a portfolio and rebalance, you can harvest some of that volatility and you don't boost the overall volatility. What we found, and this is with what most clients do, is something like quarterly is the sweet spot where you really constrain the vol and you get a sharp increase in your Sharpe ratio. But the biggest difference by far is between not rebalancing and rebalancing. One core finding of the white paper is that you should treat Bitcoin a lot like you treat every other asset, which seems obvious, but many people think of it as this exotic thing. What would you do with stocks or bonds? You would rebalance them. How often? Depends on your practice. Quarterly, biannually, annually. The most important thing is you have a rebalancing tolerance, and that is true in crypto as well.
Matt, I know you do a lot of consulting with institutional investors as well. Is it the same approach when it comes to rebalancing?
Yeah, it depends on the client. Some investors just make a small pocketed, almost side pocketed allocation and let it ride. But most people we talk to, most professional investors, are rebalancing their portfolios. They're thinking of Bitcoin not as an exotic asset, but as part of the mix, part of the gumbo of delivering better risk-adjusted returns. And it's like a really interesting ingredient in portfolios because it has high historical returns, it has low correlations, it's volatile, and it's liquid. Most people who have non-correlated assets are used to them being illiquid. They're like private equity, venture, et cetera. Crypto is liquid, and so they can harvest that liquidity by having a rebalancing tolerance. So it is pretty normal in my experience for investors to think about that.
All right. So the third question when it comes to its place in a 60/40 portfolio comes around position sizing. I have to imagine this is the number one question once somebody commits. How should advisors think through portfolio sizing when they're getting started?
Yeah, absolutely. What the data suggest is that the more Bitcoin you add to your portfolio with a rebalancing tolerance, the higher your Sharpe ratio gets over time because Bitcoin has been a very strong performer. But the data also says something really interesting, which is that your impact on the Sharpe ratio follows a almost like an asymptotic curve, by which I mean as you go from like 1% to 5%, you get this sharp positive impact on your Sharpe ratio. Your risk-adjusted returns, your Sortino ratios, they all go up significantly. After 5%, that starts to level off. And then something bad happens above 5%, which is your maximum drawdown, like the best to worst pullback in your portfolio, starts to increase really rapidly. Because below 5% Bitcoin, the maximum drawdown is driven by your equity portfolio. When you get above 5%, historically, the maximum drawdown is driven by your crypto portfolio. And as a result, we think most investors are best served between like 1 and 5%. Because if Bitcoin becomes the thing that's driving the maximum drawdown, which is what your clients feel in your gut, right? That's when they call you, which is when they have a big drawdown in the portfolio and they're upset. If Bitcoin is the driver, you can get bad behavioral results. You can get them panicking at the bottom. Conversely, you can get them getting too excited at the top. So we think the right allocation for most people is like 1 to 5%. A lot of people ask me, Matt, what is your allocation? It's way higher than that. But I am not a typical client, right? I spend my life in crypto. I have very high conviction. I have high risk tolerance. But I think for most clients who aren't, in it every day, that 1 to 5% is the sweet spot. I often call it the hot sauce of portfolio construction. Like a little bit is nice and a lot can give you indigestion.
That's a good line right there. All right, let's talk about single asset ETFs. Bitwise is a pioneer in this space. Before we were able to do it at spot ETFs, you guys had some very innovative products to provide exposure. Could you just at a high level discuss for advisors why single asset ETFs can be a beneficial solution when building portfolios? And then I'd like to go through some of your offerings.
Yeah, I think there are two cases for single asset ETFs. Look, my base case for most investors is that you should have broad-based diversified exposure to crypto. So something akin to a crypto index fund at the core of your portfolio. The quality of crypto index funds is improving in the market. Bitwise has filed to uplist its crypto asset portfolio into an ETP. There's some others out there, but that's my base case is that's the core of people's portfolios. With that in mind, there's sort of two cases for single asset ETPs for advisors, actually maybe three. One is that if you have a client who already has a large position in a single crypto asset and it's outside of your advised setting, having an ETP may allow you to bring it into the advisory setting where you can manage it appropriately within the context of the portfolio. You can tax loss harvest. You can do other things with that asset. So I think that is actually one use case that we get a lot of inbound from advisors in. How can their clients sort of in kind into the single asset ETPs? The second thing you can do with single asset ETPs is you can pursue a core and satellite approach, right? Just like we do in many equity markets, you may have a core position in the MSCI World Index, and then you may overweight NVIDIA, or you may overweight biotech, or you may overweight Tesla or whatever. You can do that within crypto as well, over and underweighting. And then the third thing we see people do is sort of creating their own index portfolio of single asset ETPs and doing their own tax loss harvesting incrementally with this asset or the other one. The goal of single asset ETPs is just to make it easy to access these crypto assets in an institutional setting with high quality custody, staking if it's appropriate, et cetera. And then advisors can use them the way they might use individual stocks or other areas of the market to overweight, underweight, do tax loss harvesting, those sorts of activities.
Matt, I'm embarrassed. I did not know that was a function of these ETPs. So if you end up with a large position, you have a client with a large position in Bitcoin, they can transfer it over to your firm and it gets added to an ETP?
It's something that we do frequently. What's happening now is they're relatively high minimums to do that, but those minimums are going down over time as the efficiency of the process improves. And one interesting thing about crypto, for advisors who have wealthy clients, there's a non-zero chance that they're sitting on a large position in some crypto asset that they bought the first time we were on this podcast and is now up 10x, or in some cases, smaller crypto assets up 20 or 30x. And maybe they made $100,000 purchase, and now they're sitting on millions of dollars. And we're increasingly seeing advisors who want to bring those into an ETP setting. Again, it has relatively high minimums, but those minimums are coming down almost on a quarterly basis to be more and more efficient to allow this to happen.
What dollar amount should advisors consider reaching out to you guys to discuss some type of solution?
I mean, yeah, great question. I think reach out at any amount. Typically you're talking in the $10 million plus range before it gets to be an interesting conversation. But again, I'd encourage you to reach out because these numbers are coming down really rapidly. The system is getting much more efficient. So what we could do 6 months ago, you're talking about like $100 million, and now it's coming down rapidly. So I don't want to put a precise number on it because I think that process will continue to get more efficient over time.
Yeah. All right. Excellent. I'd like to wrap up with just kind of your thoughts on some of the single asset ETFs that are offered through Bitwise. We've talked a lot about Bitcoin. One of the questions I get regularly is, should we just use IBIT or should we look at diversifying our ETF exposure for risk reasons? What are your thoughts on diversifying your Bitcoin ETF solution providers?
I'm sorry, Jay, you're breaking up again. Was it what separates our ETF from, say, an IBIT, et cetera?
And not necessarily separate. Is there utility using multiple ETF providers for diversification?
Yeah, absolutely. The biggest case that I could imagine for using multiple is if they use different underlying custodians. Now, I think crypto custodians are extraordinarily robust, particularly the best of breed ones that Bitwise uses and others. But we do see some advisors looking to diversify their custody exposure by rotating between different crypto asset ETP providers. My general view is that you want one best of breed, you should stick with that. But we see advisors doing that. As an example, Fidelity uses its own custodian in their ETP. So we see some advisors differing between like Bitwise and Fidelity because they're two different custodians. Bitwise uses Coinbase custody, the same entity that BlackRock uses. But we definitely see people who want that diversified exposure. I would think of it a little bit, to give people an analogy, to gold. Do you want to hold GLD only, or do you want to hold GLD and IAU? Most people are comfortable with a single high quality ETP, but some people may want to diversify their custody exposure. And we see that amongst a minority of investors.
And Matt, since we're almost out of time, I just want to ask one question on the Solana staking ETF. Could you explain that to somebody who doesn't understand staking and what the value prop is of that ETP?
Yeah, sure. So it's important to note first that crypto assets are very different, serve very different use cases. So a lot of people think of Bitcoin and Ethereum and Solana the way we might think of the dollar, euro, and the yen. But actually, the closer analogy is like thinking of three different internet companies like Google, Amazon, and Salesforce, right? Those are very different companies. They're all internet companies. Bitcoin, Ethereum, Solana are very different crypto assets, serve very different markets. Bitcoin serves a market of digital gold. Ethereum and Solana serve a market of facilitating the transfer of stablecoins and tokenized assets using blockchain-based rails. They're just very different assets. So one of the cases for Solana and for our Solana ETP is that Solana is one of the leading blockchains that allow for stablecoins and tokenized assets to move around the world at the speed of light. And so if you want exposure to the growth of stablecoins and tokenization, assets like Ethereum, assets like Solana are the leading assets in those markets. In the case of our ETP, you get this extra benefit, which is it's a staking ETP. That means when it owns Solana, it stakes those to validate transactions on the Solana network. And for that, we accrue an extra fee that the current market levels is somewhere around 7% a year. So in addition to the core return of Solana, you're also getting that staking income on top of it, which many people find attractive. So a stake tokenization play with staking, all for a fee of 20 basis points, is a pretty attractive package for a lot of people.
Excellent. Matt, our time is up. Thank you so much for coming on. If we're doing this again 5 years from now, I wonder how much worse I will have aged over that time period, but I'm looking forward to seeing where Bitcoin is at that time. Thank you very much, sir.
Thank you for having me.
The listener of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Titleist Asset Management, LLC, or TAM, is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. TAM provides its services to individuals, high net worth investors, including trusts and other legal entities, and provides access to model portfolio strategies offered through its affiliate, Shorebird Capital LP. For a copy of TAM's disclosure documents, please visit www.advisorinfo.sec.gov and follow the search instructions.